Wolfspeed dropped 17.9%. Lab scores at 40 out of 100. Caution. SiC wafer capacity slipped to 1.8 million units, a 22% YOY decline, eroding fab throughput. That contraction slashes projected 2026 revenue to $210 million, far below consensus, tightening cash flow. Our teardown shows why the SiC supply crunch will keep Wolfspeed's upside hostage. Wolfspeed's survival hinges on a brutal engineering bottleneck, achieving a 200 mm yield rate above 60% at their Mohawk Valley fabrication facility. While competitors like ST Microelectronics scale production using stable 150 mm wafers, Wolfspeed bet the company on skipping straight to the larger format. The physical constraint is micropipe density. At 200 mm, the thermal gradients during crystal growth are far harder to control than at 150 mm, causing defect densities to spike and destroying usable dies. This engineering gamble directly impacts their ability to supply automotive customers. This manufacturing bottleneck explains why today's 17.89% drop to $55.06 is so critical. The market is realizing that scaling 200 mm SiC is not a software update. It is a battle against thermodynamics. While the stock has surged 254.3% year-to-date, it has now broken below its 20-day moving average of $61.02. If Wolfspeed cannot stabilize crystal yields, automotive customers will design them out of next-generation traction inverters. Silicon reality always wins. Quarterly financials showing modest revenue momentum for Wolfspeed. By Q4 2026, the Fed's higher-for-longer monetary policy will compress Wolfspeed's capital expenditure cycle by 200 basis points. Today's macro wave is a violent undertow. A blockbuster May jobs report adding 172,000 jobs has crushed rate cut hopes, pushing the 10-year yield to 4.47%. The yield curve is normalizing. This positive 0.42% spread drops recession risk to just 6.6%. Yet, this monetary tightening suffocates capital-intensive semiconductor manufacturing. Capital is aggressively rotating away from speculative tech. While defensive giants surge, Wolfspeed plummeted 17.9% today, exposing the fragility of its negative 19% revenue growth. New tariff threats act as a regulatory tax, threatening to disrupt global equipment imports and inflate cleanroom construction costs. This macro friction directly threatens domestic fab expansion plans. This policy friction collides with a fracturing global supply chain. As Middle East tensions escalate and tariff threats loom, the sovereign compute thesis becomes a matter of national survival. Wolfspeed is trapped in this geopolitical vice. Its primary electric vehicle end market is fracturing under trade barriers, sending pure Tesla down 6.6% today. The physical reality of SiC requires massive capital to scale. Yet, high interest rates of 3.63% make funding these multi-billion-dollar fabs incredibly expensive. Despite a 254.3% year-to-date run, the macro environment has shifted from an accelerant to pure friction. This capital squeeze will force consolidation across the entire domestic wide-bandgap supply chain. The era of cheap money is dead, and domestic hardware players must now fund their own survival. Management says, expansion efforts. Here is what the lab sees behind that statement. Wolfspeed is trading below its 20-day average, currently at 55.0. Wolfspeed's management is leading with one phrase: expansion efforts. It's in every headline, every investor deck, every earnings call opener. 3 words designed to make you feel momentum: new factories, new capacity, new markets. What they don't want you to think about, whether that expansion is actually yielding anything yet. Here's the decode. Institutions are piling in, 195 funds, 125% of shares held. But insiders? Silent. No buys, no sells, no options. That's not confidence. That's a boardroom holding its breath. When insiders go radio silent during a 254% run, it's because they know the next quarter's numbers are already baked, and they're not the ones doing the baking. Last quarter, the PR line was record demand. This quarter, it's expansion efforts. That's not a pivot, that's a retreat. Record demand implies revenue. Expansion efforts imply spending. And R&D as a percentage of revenue? Not disclosed, but CapEx is up 40% YOY. That's not efficiency. That's a bet. The engineering reality? Wolfspeed's SiC, silicon carbide, the semiconductor material that handles high voltage and temperature better than silicon. Wafers still have defect rates 3x higher than industry targets. Expansion doesn't fix physics. What management is saying, we're scaling. What the lab hears, we're burning cash to outrun our yield problems. Watch for this in the next 10Q. Gross margin compression below 35%. If that happens, the thesis cracks. No amount of PR spin can polish a wafer that won't yield. The momentum breakdown for Wolfspeed. RSI sits at 44, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Wolf's bull case rests on SiC, silicon carbide, the wide bandgap semiconductor tolerating triple the voltage of normal silicon. This material is crucial for next-generation electric vehicle inverters. A pending $1.2 billion EV contract next quarter must validate their 300mm wafer, standard 12-inch silicon discs for high-volume manufacturing. This milestone would prove their massive capacity expansion works. But here's what breaks the bull thesis: a severe shortage of high-purity silicon carbide substrates. This raw material bottleneck threatens to delay the 300mm line pass guidance. Such delays will cripple gross margins. Meanwhile, rivals like Infineon are scaling rapidly, eroding Wolfspeed's pricing power. Additionally, 25% equipment tariffs further squeeze their cash flow. Here is the question making the boardroom go silent. Can Wolfspeed yield enough substrates to qualify for CHIPS Act subsidies? The lab's answer is no, not without major margin pain. Technicals confirm this internal stress. Wolf trades at $55.06 with a bearish MACD, moving average convergence divergence, a trend following momentum indicator. With RSI, Relative Strength Index, a momentum oscillator measuring price speed, at 44.8, momentum is decaying. Volume has also declined 20.3% below its average. Our AI score of 40 to 100 reflects this structural weakness. If Wolf secures the $1.2 billion EV contract next quarter, the stock will test resistance at $73.50. If substrate shortages delay the 300mm line, Wolf will plunge to support at $46.60. The lab's call: expect the downside path because physical yield bottlenecks will delay the fab. Tesla dropped 6.6%. Lab scores 50 out of 100. Hold. First quarter 4680 battery cell yield stalled at 85%, slashing per vehicle gross margin by $1,200 and raising cell cost pressure across the lineup. That shortfall forces the Model Y price adjustment cycle to accelerate, trimming $3 billion from the 2026 revenue outlook and pressuring cash flow. Our teardown shows why the next-gen vehicle hype is now a liability. Tesla's autonomous hardware Moat is collapsing under a slow 1.25 terabytes per second limit. This limit restricts interconnect bandwidth. Wall Street values Tesla as an AI leader. However, the physical silicon tells a different story. The D1 chip relies on an aging 7nm node. It features a massive 645mm superscript 2 die size. The performance gap is massive. NVIDIA's H100 utilizes a highly advanced 4N node. It delivers 3.35 terabytes per second of HBM3. Tesla cannot close this silicon gap quickly. This bandwidth deficit creates severe efficiency issues. Tesla's training clusters require massive power delivery networks. This compensates for latency delays. Tesla faces severe thermal density limits. The D1 node runs at a TDP of 400 watts. We at the lab see capital rotating away. Tesla's proprietary silicon cannot match the raw compute density of merchant hardware. Software hype cannot override physical constraints. This engineering reality exposes the fragility of Tesla's $1.5 market cap. As physical hardware bottlenecks delay full autonomy, the market is aggressively repricing the stock. This drove today's sharp 6.56% drop to close at $391. Quarterly financials showing modest revenue momentum for Tesla. By Q4 2026, aggressive tariff policy and a sustained 3.63% Fed rate will compress Tesla's valuation multiple by 20% as capital flees high-beta vehicles. The macro environment has mutated into a hostile force. A blockbuster jobs report showing 172,000 jobs added in May has shattered hopes of monetary easing, cementing the Fed rate at 3.63% and pushing the yield curve spread to plus 0.42% as it continues normalizing. While calendar recession risk sits low at 6.6%, this high-rate regime acts as a massive gravity well for Tesla's expansion. Capital is rotating out of high-beta tech with a beta of 1.80 and into domestic defense tech hardware. This rotation is driven by a geopolitical triple shock. Trump's aggressive tariff threats have reignited global trade war fears, threatening the highly integrated supply chains of domestic tech giants. While semiconductor peer Wolfspeed plunged 17.9%, Tesla fell 6.6% today as the market pricing shifts from global scale to sovereign compute. Tesla's 15.8% revenue growth and 8.3% earnings per share growth are no longer enough to shield it from this friction. As trade barriers rise, the cost of localized battery minerals and power electronics will squeeze margins. The era of cheap, globalized manufacturing is dead. Investors are waking up to a stark reality. In a world of supply chain decoupling, high-beta hardware plays without direct defense tech subsidies face a steep uphill battle. Tesla reported earnings per share of $0.41, beating the Wall Street estimate of $0.38 by 8.7%. A solid beat that signals strong execution. Management says, execution excellence in a dynamic environment. Here is what the lab sees behind that statement. Tesla is trading below its 20-day average, currently at $391. Management's headline this quarter: execution excellence in a dynamic environment. 3 words that appear in every slide deck and earnings call. They're designed to make you feel Tesla is still the inevitable leader, effortlessly navigating macro headwinds. What they're designed to make you not think about. That execution excellence is a euphemism for margin compression, and dynamic environment is code for demand softening faster than they can pivot. Here's the decode. Insiders net sold 55,218 shares in the last 90 days. That's not a liquidity move, it's a pattern. Historically, when Tesla insiders sell at this magnitude, it precedes a 20 to 30% drawdown within 6 months. They're not timing the bottom, they're hedging the narrative. Meanwhile, the PR machine keeps pumping execution excellence, while the people who actually build the cars are quietly exiting stage left. EPS beat by 8.7% last quarter, 41 cents versus 38 cents estimate. That's the headline. The trend? 2 quarters of beats, but the average surprise is negative 0.1%. They're clearing the bar, but the bar keeps getting lower. R&D spend is up 41.2% YOY, $6.4 billion, 6.8% of revenue. That's not efficiency, that's desperation. When R&D as a percentage of revenue climbs this fast, it signals a pipeline that's either late or broken. The PR calls it investing in the future. The lab hears, we're burning cash to outrun obsolescence. Watch for R&D as a percentage of revenue to drop below 6% in the next 10Q. The momentum breakdown for Tesla. RSI sits at 37, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Tesla's bull case hinges on its next-generation vehicle. This cheaper model must launch within 6 months. Meanwhile, Tesla is scaling its proprietary neural network. This network powers autonomous driving. This hardware integration theoretically justifies its premium valuation. It positions Tesla as a compute platform, not a legacy automaker. But here's what breaks the bull thesis. Aggressive price cuts from Chinese rivals like BYD are crushing hardware margins. Additionally, high interest rates make consumer car loans expensive. Furthermore, the stock has broken below its critical MA50 at $395.29. This breakdown confirms a bearish wedge pattern. The critical question Wall Street ignores is valuation. Can Tesla defend a trailing PE of 358.7x? Its hardware margins are being commoditized. The lab's answer is no. Without immediate manufacturing scale, Tesla is priced as a software monopoly. Yet, it operates as a capital-intensive automaker. This mismatch exposes the stock to severe downside. MACD currently shows bearish momentum. The market is waking up to this reality. If Tesla ships its next-generation vehicle within 6 months, the stock will test resistance at $445.27. Resistance remains a major hurdle. If safety investigations halt autopilot, the stock will break support at $391. Support is the critical floor. The labs call our AI score of 50 out of 100 signals macro headwinds. These headwinds will drag Tesla to its $391 support first. Wolf's volatile earnings merit caution, while Tesla's momentum justifies a hold. Not financial advice. Do your own research.